Before stocks, before real estate, before side hustles and portfolios, there is one investment that quietly determines whether all others will succeed or collapse under pressure. It earns no applause. It rarely makes headlines. It does not compound invisible numbers. And yet, financial celebrities across books and biographies return to it with near unanimity. The emergency fund is not a financial tactic. It is a psychological foundation. Most people misunderstand emergency funds because they evaluate them through the wrong lens. They ask what the return is. They compare it to equities. They see idle cash as wasted potential. But financial celebrities evaluate emergency funds not by yield, but by what they prevent: forced selling, panic decisions, desperation trades, loss of leverage at the worst possible moment. The return is invisible until the day it saves everything else. Early in their journeys, many financial celebrities learned this lesson the hard way: a sudden layoff, a market crash, a business deal that unraveled overnight. In those moments, the presence or absence of liquid safety determined who could think clearly and who could not. Books consistently show that early career collapses were rarely due to lack of intelligence. They were due to lack of runway. An emergency fund buys time. Time to think, time to choose, time to say no. In finance, time is optionality. Without it, even the best strategy becomes fragile. With it, mistakes become survivable. This is why financial celebrities treat emergency funds as insurance for judgment rather than money for emergencies alone. Another critical misunderstanding is that emergency funds are for the cautious or risk-averse. In reality, they enable risk-taking. Financial celebrities who built outsized fortunes often took bold career and investment risks, but only because downside survival was already secured. The emergency fund creates a floor beneath experimentation. You can only jump higher when you know the fall will not kill you. Psychologically, the emergency fund changes how the brain processes uncertainty. Without it, every unexpected expense feels existential. With it, problems shrink to size. This shift in emotional scale dramatically improves decision quality. Books describing investor behavior repeatedly highlight that poor decisions often occur when financial stress compresses time horizons. Emergency funds expand them. Another subtle benefit lies in negotiation power. Financial celebrities emphasize that the ability to walk away is the most underrated form of leverage. When your rent, food, and obligations are covered for months, you negotiate differently. You decline bad deals, you wait for better ones. You are not forced to trade long-term value for short-term relief. Emergency funds transform posture before they ever touch numbers. There is also a moral dimension rarely discussed. Without an emergency fund, people are more likely to compromise values under pressure, accept unethical work, stay in toxic environments, make decisions misaligned with long-term identity. Financial celebrities recognize that liquidity preserves integrity. It allows alignment between principles and action when circumstances test both. The size of the emergency fund matters less than its existence. Some celebrities held 6 months of expenses. Others held years. The commonality is not the number, it is the intention. The fund is segregated, untouchable except under defined conditions. It is not opportunity capital. It is not lifestyle enhancement. It is stability capital. Importantly, emergency funds are designed to be boring. They are not optimized. They are not traded. They sit where accessibility and safety matter more than return. This boredom is intentional. Financial celebrities understand that excitement is the enemy of reliability. The emergency fund must work in silence, without demanding attention or cleverness. Another insight emerges when examining market downturns. Those with emergency funds rarely become forced sellers. They ride volatility instead of reacting to it. They do not liquidate investments at the bottom to cover basic expenses. This single advantage explains a disproportionate amount of long-term wealth divergence. Survival is underrated because it does not feel productive until it becomes decisive. Emergency funds also change how success is experienced. Without one, financial wins feel fragile. With one, progress feels secure. This emotional difference influences behavior. People with safety nets plan longer. They invest more patiently. They resist lifestyle inflation because they understand the difference between comfort and security. Financial celebrities also frame emergency funds as personal responsibility. Before allocating risk to markets, They ensure risk to life is buffered. This sequencing reflects maturity. You do not ask volatile assets to perform the job of stability. You assign each asset a role. Emergency funds exist to absorb shocks, not to grow. Another overlooked function is stress reduction. Chronic financial stress erodes cognition. It narrows focus. It accelerates burnout. Financial celebrities treat emergency funds as mental health investments. The peace of knowing you can absorb disruption improves sleep, creativity, and restraint. This mental clarity often produces better financial outcomes indirectly. There is also a generational lesson embedded here. Financial celebrities who grew up in instability often overvalue safety later. Those who grew up secure sometimes undervalue it until tested. Books show that those who respect emergency funds early tend to build wealth steadily. Those who skip them often oscillate between growth and collapse. Emergency funds are also a boundary between personal finance and investing. They mark the point where speculation ends and stewardship begins. Financial celebrities insist on this boundary because they have seen what happens when it is violated. Investments forced to serve emergency needs are robbed of time, and time is the only ingredient investing cannot replace. The paradox is that emergency funds feel most unnecessary right before they become essential. When income is stable, when markets are rising, when confidence is high. This is precisely when financial celebrities reinforce them. Preparation feels excessive until it proves insufficient. And this is where the story begins to narrow. Because once we stop viewing emergency funds as conservative leftovers and start seeing them as the first and most important investment in personal stability, the entire order of financial priorities rearranges itself. The emergency fund is not money waiting to be used, it is money working invisibly to protect every future decision. It is the quiet buffer between ambition and ruin, between patience and panic, between long-term thinking and short-term survival, forming the foundation upon which all other investments either stand securely or collapse without warning, revealing that wealth is not built by maximizing returns first, but by eliminating fragility first, as true financial progress begins not with growth, but with safety, unfolding not dramatically, but deliberately, like unfolding not dramatically, but deliberately, like a seatbelt you only notice when the impact arrives. And this is where the emergency fund reveals its deepest truth, not as cash sitting idle, but as the invisible structure that allows every other financial decision to function under stress. In the second half of this lesson, financial celebrities converge on a realization that often surprises beginners. The emergency fund is not a phase to graduate from. It is a permanent layer of the financial system. As income grows, complexity grows. As assets increase, exposure multiplies. The need for a buffer does not disappear, it changes form. One of the most important shifts happens when people stop asking, how big should my emergency fund be? And start asking, what kind of risk does my life now carry? Financial celebrities tailor their safety nets to volatility, not rules of thumb. A stable salary requires one structure. Entrepreneurship requires another. Public markets, private businesses, family obligations, health risk, each adds a layer of uncertainty that must be absorbed somewhere. The emergency fund absorbs what diversification cannot. Another crucial insight is that emergency funds protect identity, not just expenses. Without one, people cling to jobs they hate, businesses they've outgrown, or investments they no longer believe in. With one, identity becomes flexible. You can change direction without collapsing. Financial celebrities repeatedly emphasize that freedom of choice is the highest return any asset can generate, and emergency funds are the down payment on that freedom. As wealth increases, emergency funds often evolve into liquidity buffers spread across structures. Cash reserves, short-term instruments, undrawn credit lines, and conservative assets. But the principle remains the same. There must always be capital whose sole job is to not fail when everything else is under pressure. This capital is not optimized, it is insulated. Another pattern emerges around self-trust. People with emergency funds trust themselves more under uncertainty. They do not second-guess every decision. They are less reactive to headlines. They are less vulnerable to panic narratives. This confidence is not arrogance, it is stability. Financial celebrities understand that self-trust compounds faster than returns. Emergency funds also clarify the difference between voluntary risk and forced risk. Voluntary risk is chosen, sized, and reversible. Forced risk is reactive, emotional, and often permanent. The emergency fund removes forced risk from the equation. Once removed, investing becomes strategic rather than desperate. Importantly, financial celebrities warn against the temptation to blur boundaries once things go well, using emergency funds for great opportunities. Treating them as backup capital for investments, this erosion usually happens during optimism and proves catastrophic during downturns. The emergency fund only works if it remains sacred. Once repurposed, the entire system weakens. Over time, people who maintain emergency funds experience fewer dramatic stories but far better outcomes. No heroic rebounds, no desperate comebacks, just steady progress. Survival rarely feels impressive, but it is the quiet prerequisite for every impressive result that follows. And so the lesson resolves into something deceptively simple. Before chasing returns, remove fragility. Before seeking growth, secure survival. Before asking money to multiply, ask it to protect your ability to choose wisely under pressure. Financial celebrities did not build wealth by being reckless early. They built it by making sure no single moment could end the game. If this reflection resonated with you, pause and ask yourself one question. If income stopped tomorrow, how long could your life continue unchanged? The answer is not a source of shame, it is a map. Share that thought. And if you want to keep building wealth from a position of strength rather than urgency, stay connected. Subscribe, follow, and return. Because the first investment is not the one that makes you rich, it is the one that ensures you never have to start over.